Welcome back. You're watching Stock Watch with me, Zinati Kuma, and joining me to take your stock-related questions tonight are Willem Oldewage from Nitrogen Fund Managers and Grant Nader from Benguela Global Fund Managers. Please be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag StockWatch. Thank you so much for your time, gents. Pretty interesting moves that we saw on the JSE today, and actually the biggest moves are coming from the gold miners. Harmony being beaten down by about 8%. Grant, what was responsible for the removal of shine from these gold miners today?
Yeah, good evening, Zanat. Yeah, precious wasn't very precious today. We saw, the gold price come under pressure last night with that sell-off in the US, and then it followed through today on the back of that economic data as well, down like 2% over the sort of past 24 hours. And so I think that's really just enough to see a bit of the shine come out of these metals, which have actually had a decent bounce in the last couple of days. So giving that back, PGMs as well came back quite a bit. They were the market leaders yesterday, so giving a lot of that back today. I don't think one should read too much into it. There's a lot of noise at the moment, a lot of volatility. Markets was down over 1% today as it was closed up in the green. So there's been quite a lot of movement in the system, quite a lot of volatility, and I don't think one should read too much into it yet.
All right. Well, talking about the sell-off that we got in the US yesterday, quite a different story that we are seeing today. Willem, is it all the GDP data for the second quarter that we got out, and does it have any impact on how markets are seeing the direction of monetary policy from these numbers that we got today?
Yes, so I think the build-up from last night and even maybe the last week or two in US tech is more a function of the narrative and the economic reality of AI playing out. And so if you look at the big sort of magnificent seven stocks and their adjacencies, things like Intel, Nvidia, AMD, even something like an Adobe that's based off of sort of that AI narrative unfolding, I think the market's coming to realize that that's not necessarily economically as viable as it is, in share prices. And then coupled with that, today we got two big numbers. PCE, which is personal consumption expenditure, is the Fed's sort of number one barometer of sort of the health of the consumer, and then US GDP, which were both very strong, which of course takes the idea of stimulus or sort of more accommodative monetary policy further down the road, which impacts things like the gold price and equity prices and even, cryptocurrencies, as you'd rather sort of keep the dollar cash if there's yield than sort of switch into a risk asset.
Yeah. Well, talking about stimulus, because we did also get China adding more stimulus and cutting interest rates for the second time this week. And of course, that links to the kind of headwinds that the consumer is experiencing and obviously how we're seeing that impact in the luxury market. There's a question here. I've heard many of your market commentators punting luxury counters like LVMH and Richemont. Looking at LVMH results, clearly the luxury sector is not bulletproof. Any comments on the luxury sector? Would you still say that even, Grant, with the kind of dip that we are seeing in earnings, particularly from China, in the luxury stocks, that it's not bulletproof, or maybe this is just a short-term blip?
I think I think they did get ahead of themselves post-COVID in all that revenge spending, especially when China reopened. So there was a big uptick in all the luxury sales, and nothing is impervious to economic cycles, and China is struggling to recover. So I think what we're seeing is quite a good normalization of that luxury goods cycle. But you have also seen a bifurcation between the highest quality luxury and the lower quality luxury, the likes of Burberry, Kering with Gucci, and these guys are really struggling. Their numbers are getting cut dramatically. But at the top end, you're seeing Richemont, LVMH, Hermes, they're holding up really well. Yes, they're coming under a little bit of pressure, but they've had a really good couple of years. And I think this sell-off is exactly what you need, which provides you with a decent entry level again if you missed the boat on the first time round.
Should we be celebrating, Willem, that we've got Richemont right here on the JSE?
I mean, that's a very good point. They've got quite a few of these sort of legacy things, Remgro way back when decided to invest in a Swiss luxury sort of brand, and we sort of become a very large part of our index over time as the sort of, the share prices evolve. I think it's a bit of a double-edged sword because it has nothing to do with our economy. So all of our pension funds, all of our sort of mutual funds are exposed to it. But I mean, you're taking a view on global luxury and to a large degree China, which is already such a large part of our index. All our resi, all our Naspers and Prosus, a few other companies, plus now Richemont, are exposed to one economy, which is, I'm not saying it's panic, but I mean, 2 rate cuts in a week is sort of emergency measures to try and stimulate that economy. And now we've sort of got this massive exposure. So yes, it's positive that we've had the exposure up until now. But in terms of sort of an indexing point of view, it cuts both ways.
Yeah, it's actually quite interesting. I mean, just, what you say, Willem, that there's so much exposure to China in a lot of these equities. Grant, it seems that, everybody is exposed to China in some way. So at this point, do you just ride out the headwinds and the kind of weak demand that we're seeing from the consumer and kind of hope that at some point it bottoms out?
Yeah, I think there's a lot of this weakness reflected in the valuations already. And of course, when we talk about weakness in China, it's all a relative concept. This is the second largest economy in the world. It's still growing between 4 and 5%, more toward the 5 than the 4. I mean, that's an incredible rate of growth, but we're used to the 6s and 7s of the past. So in a normalized world, it's actually still quite an attractive rate of growth. The valuations are really cheap relative to history. But of course, it's the uncertainty, it's the regulatory intervention, it's the policy direction, it's the trade wars, the geopolitics. There's all that uncertainty, which is generally over time, those kind of events are what give you opportunities, but they also pose some risk. So you have to ask yourself, is enough of that risk in the price? And I think for some of the counters, and I think one does need to be careful of what you're buying in China, because not all sectors are made equal over there. You can find some value that probably has enough value to offset some of those risks with a decent growth prospect as well, if you're patient.
All right. Well, Willem, you mentioned AMD earlier on when you were talking about the AI tech stocks. There's a question here on AMD. Is it still worth a hold for the long term?
Yeah, well, I think the question sort of answers itself. For the long term, definitely. In terms of sort of near-term price fluctuations, the Nasdaq is incredibly volatile, and it comes somewhat from the ratings and somewhat from the sort of underlying earnings growth. If you've got sort of 10% earnings growth and a I don't know, maybe 20% ratings change, you get that multiplier effect. So if they miss by a very small amount or beat by a very small amount, you're going to sort of be exposed to a lot of volatility, which you should be rewarded for in your equity risk premium, which means if you're investing for the long term or for your retirement, there's no reason to sell a stock based on a quarterly report. So definitely yes, and the sector makes sense. It's part of sort of the modern world. It's chips. It's not like we're going to stop using phones or computers or televisions or anything that those things are used in. So in terms of sort of the economics of the business, there are sort of 2 big businesses, Intel and AMD, and maybe NVIDIA in terms of graphics. But you're very, very well moated in terms of sort of competition. And it's a high quality management that's been doing it for a very long time. So yes, I would definitely hold it for the long term.
Grant, where would you be seeking value within this AI sector? Would you go for the clear winners like NVIDIA that have really participated in this bull market? Or do you go for some of the other ones that maybe even though they have participated a little bit in the rally, but they haven't really participated to their full potential where maybe the share prices could still look attractive?
Yeah, absolutely. It's a great question, and we ask ourselves that a lot. So there's a few areas that I think pose potential opportunity. The one is the IT consultants. So we've got this massive capex rollout, all this hyperscaler build, and everyone's asking, well, where does the monetization of that come from? So once this is built, then the next thing people need to do is figure out how to use it, how to put their data on the cloud if you haven't already done it, and then figure out how to harness these new AI tools. And that's where your IT consultant, your Accentures, or your Globants or other tech McKinseys of the world, I think there's an opportunity there for them to step up. Alternatively, you also got a lot of these software providers, where such as a Salesforce or Adobe, for example, where the money seems to be, some of the money is being diverted. It's unclear that they're getting there's question marks around whether they'll be displaced with the new technology. I think they're perfectly positioned with deep enterprise knowledge and a deeply entrenched base to actually harness this opportunity and grow from here. So I think that's the next wave when it comes to the monetization and the killer app type of phase. We're not there yet, but that's where I see opportunity, and a lot of these stocks have sold off in this uncertainty.
Yeah, talk about that sell-off before we go to the break quickly. Willem, would you be seeing this kind of dip that we've seen in that sector as a buying opportunity, or are the valuations just still way too full?
I'm fairly conservative, so I'd be patient, just given today's PCE data and the fact that the US election coming up. I think long term, I don't think it's a bad idea, but personally, I'd sort of wait for a real dip. I mean, the Nasdaq can fall way more than sort of 8%. Obviously, we've seen much bigger dips there in the past.
All right. Jen, some more questions for you. This one is on Investec. What is the view of the panel on Investec? Is it a good buy and to hold it for the next 3 to 5 years? Yeah, quite a long term, 3 to 5 years. Willem, would you be comfortable holding it for that long?
Yeah, I think Investec's a very good company. They're sort of a large, sort of high net worth individual bank. Lots of exposure globally and some of it in South Africa. I can't see any sort of negatives to it. Maybe you're going to buy a bank that they perform well. They have sort of good net interest income, good ratios, very good client base, generally good risk in terms of their debt. So in terms of sort of a banking portfolio, as either part of it or sort of your main pick, I can definitely sort of vouch for that, yes.
Okay. Grant, would you be on the same page or not?
Yeah, I like it. I think the last couple of years have done a lot of work to shed that capital overhang that they've had. They've had a very lazy balance sheet, a lot of unproductive assets that they've offloaded. You're starting to see it come through in the ROEs, which is a key banking return measure. They've got nice diversification of income sitting in the UK. They've got the wealth business. I think it's a good little business. It's focused on they know where they're operating. They focus on their niche, and they're in a fairly defensive segment of the market. I like what they're doing, and yes, I would hold it for the next 3 to 5 years.
All right. Well, yeah, something that's maybe less stable, Tesla. Comments on Tesla results, please. And it's actually been quite interesting because after being beaten down last year, we did have Tesla actually, or earlier this year, we did have a recovery in that share price. Of course, maybe a little bit of a dip after those results. Willem, yeah, your thoughts on those results?
Well, I think that's sort of like almost as can be expected. Maybe the retail market didn't like it, but there's no way that sort of economics can last for long. Like if you just look at the broader space, like BYD in China, and sort of Chery and Stellantis and Toyota and sort of the VW group, all of them are competing. There's no way that the returns can stay that high. It's a competitive sort of global environment. And for a very long time, conservative investors have kind of been saying this, and they've sort of had their sort of, words fed back to them. But I think ultimately the market's efficient, and Tesla is a big story and sort of a beautiful sort of, like video of Elon Musk. But ultimately, the truth is they're not going to replace every other car maker in the world. It is competitive, and the returns will normalize in line with sort of a normal car maker, maybe sort of a more luxury car maker, maybe let's say like a Porsche rather than a Fiat. But it stays true that they have to sort of compete in the same environment. So I've never been a big fan of the Tesla investment case, and I think slowly but surely the truth is coming to bear.
Yeah, I've actually heard that a lot, that conservative investors have been very cautious on Tesla. Where would you be on that fence, Grant?
It's a different one. So I think if you want to buy a car company, Tesla's probably not the one, because they're still over earning at the margin. They're currently earning around 14.5%, which fell 4%. That margin.
I mean, also Grant.
Car company.
Also, Grant, do you take it as a tech company or a car company?
Well, I think that's the critical point. You can't make a really good investment case on the car piece. So the average car companies earn between 3 and 10% margin. They're still earning over 14, and so they're going to keep coming down, as Willem rightly said. I think if you want to own Tesla, you've got to believe in the optionality of full self-driving, of the robo-taxi, of the potentially the enhancements around this robot that they're building. And there are, I mean, one thing is clear: if AI plays out, they are at the forefront of the opportunity set They've got more, FSD miles, full self-driving miles. They've got one of the world's biggest supercomputers they're building, and they've got all the tools they need to get it right. But that might be in a couple of years. It might not be as quick as Elon Musk thinks. He's got a habit of over-promising and under-delivering. So I think you've got to say, I'm taking a high-risk bet if I want to play on this thing, but I'm playing it for the optionality of these other vectors, not of the fact that it's going to be a great car company, because the Chinese guys are going to outcompete with them, outkill. They're already doing it in China. They can't match them on a production volume cost basis. So you've got to believe in something of the bigger story.
Okay.
I'm not saying they will get it right, but if they do, there's optionality there. If they don't, you're going to lose money over time.
Let's go into British American Tobacco, because it did release its interim result here, and what was actually quite interesting is how much the share climbed today. Willem, did the market reaction go with the numbers?
Yeah, well, the market's never wrong, so I'm definitely not going to disagree with that. British American Tobacco has always been the ultimate value play. It's sort of a hard currency yielder, and then you have this sort of excess risk overlay in terms of regulation. So it's always been the sort of two sort of bulls butting heads, are they like a good yielder, or are they going to sort of get regulated out of the market? Because you hear all the stories about, especially the sort of e-cigarettes, or I think it's vaporizers is the word they use, in terms of child use, and sort of lots of action lawsuits in the UK and in Europe and in the USA. So ultimately, the economics are really good of the smoking business. There's nothing sort of negative about that, but the business has this super weak valuation based on the fact that there's constantly a risk overlay. So, I mean, what that leads to is a low multiple, which means a very small change in the multiple. If you go from 5 to 6, it's 20%, versus if you go from 20 to 21, it's 5%. So the positive reaction is generally sort of overdone. Same with the negative reaction, and a tiny beat would lead to a very positive result, as you see today.
Yeah. This kind of regulation overhang that seems to be impacting the valuation grant. Do you think that that's just a good an opportunity that the markets should use, because the shares seem so cheap considering what you're getting?
Yeah, look, I think it's a share that's going to stay cheap. So you will get returns in the dividends, but they're growing in low single digits, and earnings and revenue wise, that's probably what the investment, that's as good as it's probably going to get, unless the e-cigarette or the new age portfolio continues to grow without further regulatory intervention, because that is growing unbelievably, and you just have to look around you to see all the youngsters vaping and whatever else they're doing. So I mean, that's a growth trajectory. If you're looking 3-5 years forward, there might be a story there. But if you're looking at the core business, I don't think there's anything very exciting there. It's a good rand hedge. You can park your money there and sleep at night, but it's never going to shoot the lights out. I think the regulatory overhang and the way the world is moving far more health orientated, and people are moving away from smoking. I mean, you hardly ever see people smoking cigarettes anymore. So it's got a sort of a place in a portfolio, but it doesn't excite me generally, I would say.
Well, talking about movements, we did also have Spar announcing or posting a further cautionary announcement today, saying that the talks for the disposal of Spar in Poland are at an advanced stage. How encouraging is this, Willem? Does it seem like Spar is really on a solid footing in terms of turning its business around?
Yeah, so that's been a long time coming, and I guess this is a further cautionary, so it's even longer. I mean, Spar, you can break it up geographically. Sort of Spar is saying they've sort of done really well in some places and not that well in others. So the Poland business, the first idea was to try and fix it or turn it around and sort of use capital, but ultimately I think they've at least correctly identified the problem, and they've got a solution for the problem. In terms of the value realized, it's sort of, for investors, it is a bit of pill to swallow, because they've sort of been, waiting for the promise of Poland turning around and ultimately sort of giving up on it. But in terms of the long term, I think the realization is correct, and I think hopefully we get a fair price for the business. Not that it's difficult, it's not profit making, but there are obviously other operators that understand the market better, believe they can sort of extract efficiencies, but so ultimately still marginally disappointing, but at least the right steps are being taken to sort of correct the prime misstep.
Yeah. I mean, just considering how much investors have been hurt with Spar grant, would you say that maybe this could be a good time for investors to kind of start nibbling on the stock again, or maybe they've been hurt so much that they should just wait until you can actually see the numbers that they are really on a solid upward trajectory?
It's a good question. I mean, it has rallied probably close to 40% off its lows. So I think this Polish deal is in the price. It's the issue. The risk here is that they don't close the deal, but it looks like they're going to. So I think there'll be some relief around that. They've got a lot of work to do to stabilize the core South African business. Shoprite has been, or Checkers has been, eating everybody's lunch under their noses while they were off in Poland and Sweden and Ireland and all that sort of thing, or Switzerland. So I think there's a lot of work to be done. They've got to pay down their debt. They've got a mountain of debt they've got to get on top of.
Yeah.
They're moving in the right direction, but it's a slow burn. I think you'll be okay if you own it here, but I think the opportunity for a quick, real nice return was below 100. It's now at like 121. So that sort of ship has partially sailed. The risk reward is a lot less appealing over where it's trading now.
But I mean, would it be maybe slightly more appealing than Pick n Pay, Willem?
Sure. The two businesses are so different now with the Pick n Pay rights issue. I really like the Boxer business, so I'd pick Pick n Pay between the two, mainly because I'm not sure about the Pick n Pay legacy model and the franchising and all of that. But the Boxer business, I think sort of the ultimate unbundling, it's worth getting into. And the current rights issue is sort of putting some pressure on the share price. It rallied a lot in the build-up, kind of went from like 14 to 28, and I think the implied post-rights price is maybe something like 21, 22. It depends. It moves so often, but I think that's a good entry point, and you sort of get the Boxer business, which will be spun off, plus sort of the Pick n Pay legacy business, in my mind, for free. I think the valuation is sort of all in the Boxer side, and you get like a sort of picker if the sort of legacy business does well. So yeah, between Spar and Pick n Pay, I definitely pick Pick n Pay at the moment.
Quick one on your front, Grant, Spar versus Pick n Pay?
That's a tough one. Yeah, I would have said Spar at 100, but I think here Willem's probably leading in the right side. There's a bit more upside, I think, on the Pick n Pay trade. It might be a little more risky because they still have a lot of debt as well, but I think you can make good returns if Boxer comes through.
All right.
It's a good business.
All right. Well, gents, let's get to your stock picks for today. Willem, what are you picking?
Just given the sort of recent, I guess, risk-off sentiment globally, I want to pick something conservative. So I really like the Tencent business, and then obviously our plays on that on Naspers and Prosus. So the Naspers discounts deeper towards Tencent, and then there's sort of a discount to Prosus, which I think is the right way to play it. I believe in the sort of current management. I think Fabricio Bloisi, the new CEO, is the right person in terms of their remaining sort of rump portfolio because of the large exposure to food delivery. And I think there's nothing that stops the ongoing catalyst of switching their Tencent into Naspers at the current price. And I think it's very hard to go against that flow. And with Tencent very depressed, it's all from 400 Hong Kong dollars to 350 now, and there's a big discount. I think you've got an incredibly large amount of protection in Naspers, and then you share in all the upside, the potential upside from China, the potential upside from the food delivery, and the potential narrowing of the discount. So I think Naspers makes a lot of sense in the sort of current pricing environment.
Grant, what is making sense to you today?
I'm going to put my money where my mouth is. My stock pick is Salesforce. It had a good 25% pullback from its highs, as the software stocks pulled back. They are the leading CRM, customer relationship management software in the world. They have about a 22% market share. It's an incredible cash machine, and it's trading the cheapest on a price to free cash flow basis that it's traded at in years. It's down at around 20 times next year's cash flow. And I think they're well positioned to benefit from this continued and accelerated migration of data onto the cloud, and actually utilizing that data to drive business revenue and value creation. So that's my pick of the day. Salesforce, great business, high quality, and a great opportunity in this pullback.
All right. Well, thank you so much for your time and for your analysis today, gents. I really appreciate it. That is all for tonight's Stock Watch. Thanks to our guests, Willem Oldewage from Nitrogen Fund Managers and Grant Nader from Benguela Global Fund Managers. Up next, The Close. Stay tuned. Cheers.